Well, welcome everybody to our annual gala. The February roundtable is always reserved for our awards program. We'll do our traditional sharing of best ideas at this time also, but just wanted to basically say we're joined here by virtually everybody on that cover slide tonight with just a couple of exceptions. Kim Butcher is actually going to get some awards tonight. She's not able to join us, but she's going to listen to the recording in the future. So everybody give her an internet round of applause at the appropriate time. Ken Kabula is here. Herb Lemkool is joining us from warm and sunny and thunderstormy Florida. Silence from Atlanta. Susan Michelik from southern Wisconsin. Ann Manning from Houston. Hugh McManus from Southern California by way of Pasadena. My name is Mark Robertson. I don't know if Matt's here, but I think he probably will be. And Nick Strategos wasn't able to join us, although he was going to try to at some point. So welcome to everybody. Big hugs all around. We do have some celebrating to do, so we'll get onto that here in a few minutes. But this is our sixth annual celebration or awards presentation. We'll get the legalese out of the way here. We are going to talk about ideas that we have right now, share that analysis with you, and no investment recommendation should ever be intended. This is about a demonstration. The education involved in the philosophy and the techniques and methods used by the Modern Investment Club, also known as NEIC or Better Investing. I work with Manifest Investing. We all use the same playbook. We're looking for high quality companies and when they're on sale. That's what we do, and we're going to be demonstrating that here tonight. So you'll hear some stocks, and we'll go over them and demonstrate as for illustrative purposes only tonight.
Matt, you can say hello to the whole group. Mark, Matt has joined us in the celebration room as well.
Excellent. Big time attendance tonight. Hi, Matt.
Hello.
All right, here's our standing agenda. If you're new to this, again, a big welcome and an extra big hug for those of you that have been with us many times over these past 6 years. We'll talk a little bit about results tonight. We'll kind of go through that pretty quickly because we will be handing out awards for some of the best selections over the last year, best selections all time, accuracy, people's choice, but we do have interspersed amongst all the presentations some awards for as you can see there, the all-time and the annual awards and that kind of stuff. And then we also have the stock presentations. We'll be looking at Amgen, although Kim's not able to join us. Take a quick look at that one, kind of on the heels of last month's Biogen nomination. Kim also sees the biotech sector as being savaged and possibly a host of opportunity now. Ken will cover Cerner. I'm going to talk about Stifel Financial. Cy is First Financial, and Hugh is going to come back and I think quadruple down on ConocoPhillips, and we'll have a poll at the end. Just as a reminder, we're here basically to talk about and share ideas about some of our favorite investment opportunities at this time. We do keep track of what we bring to you. Over time, we would like to see the collective aggregate performance of everything that we do during these roundtable webcasts actually add up to a return that beats the market, an excess market return of 5 percentage points, beating the market by 5%, as you can see there. We use the Wilshire 5000 as that benchmark. We also would like to see, 3 out of every 5, 3 out of every 4 selections that we make actually outperform the market during the period since the time of selection. Here's a quick look at our scoreboard over the years. It's a trend that we really do like. We are hoping to get up to that red line, which is our target relative return. And again, the relative return is the excess market return or the return above the Wilshire 5000 benchmark. So if we hit that line, we're actually 5 percentage points better than the market. You can see that we've been up kind of close to it, but again, the trend is in the right direction after a fairly shaky, slow start. And again, that's something that we do see in some investment clubs. We'll be talking about that a little bit here tonight. The actual annualized rate of return, and that's an internal rate of return, is approximately 11% over these past 6 years. And a little over half of our selections have actually outperformed the market. But that 11% isn't bad. There's nothing wrong with 3%. We want to get to 5. In fact, we'd like to get between 5 to 10 up into that blue shaded area. But pretty strong performance collectively, and definitely worth celebrating. I will point out that the night did we shed a couple pounds here between last month's broadcast and this one. He's actually a little bit leaner. He's still got some work to do, but by audience demand and suggestion, the knight has been on a diet for the last couple of months, so he's getting a little trimmer. Any comments from the knights and damsels out there?
Well, Mark, this is a 5.5 year experiment now, and I would take a 3% plus on the market for any 5 year investment that you could point out to me. I think that's super. That's as good as one of my best investment clubs is doing. They're doing it over a much longer period of time, but I think 5 years is significant. If you can show me a mutual fund that has done that well in the last 5 years, I'd certainly be interested in it as well.
Yeah, that's something we maybe could take a look at as an educational topic. Go ahead, Hugh.
No, I certainly agree. What Ken said. It's a stellar performance, and despite some of my recent picks that have dragged the thing down a little bit, but still good.
all a matter of time, right?
Yeah.
And that's certainly important to remember what Ken and Hugh just mentioned relative to mutual funds, but also remember even a 1% outperformance over a 20 or 30-year time period, which is what you're looking at. Some of us speaking tonight may not be looking 20 and 30 years out with all our money, although we're going to be around that long, we hope, but someone in their prime earning years or just starting out is looking at a 30, 40-year time horizon, and just 1% can be huge over that period of time. So you talk about 2 and 3%, it's pretty tremendous.
Mm-hmm.
Absolutely. If you start early enough and keep with it on a nothing dramatic, just a nice regular input of cash, you have a lot of time to really put something together that will make a big difference in your life.
Yeah, and with that,
there's nothing shabby about it. Oops, nothing shabby about 11% return either.
Not at all.
No.
No, and I thought what I
would just reading
is take a look at, again, as we mentioned in the opening, we're talking about discovering and taking ownership in high quality companies, but only when they're on sale, and holding them for as long as it makes sense to do so. So what you see here is our tracking dashboard. For those of you that are not Manifest Investing subscribers, that is a public link at the top that you can follow along. What we do every month is the selections that are made, the decisions that are made, we take and invest $1,000 into each one. Some of them have been invested several times. Cognizant Technology is, I believe, a 10-time selection. So $10,000 has become $17,000 at the top of the chart. But you can see from top to bottom, some of those have actually only been picked once or twice and grown to the $3,000, $4,000, $5,000, $6,000 numbers that you see there that basically allow us to build on that type of performance. We'll be looking at specific performance on specific decisions here in a few minutes, but again, top to bottom, nothing dramatically weak about the portfolio. Decent quality, decent return forecast. We'd like to see it a little bit higher. We actually would like to see the overall average growth, that's top line growth for the portfolio, to be a little higher, but it's not an emergency condition in my opinion. We'd love to see that in the 10, 11, 12 range down here at the bottom. But again, top to bottom, pretty solid.
Mark, these totals at the bottom are representing the entire group of stocks that have been chosen, right?
Yes, they are.
Not just the ones on the screen.
Right. There's probably, I don't know, 60 to 70 companies in the portfolio now. You're actually looking at the top 20. Okay.
Or maybe we should say the largest 20 holdings, right?
Yeah, the largest 20 by the value of the.
By value. Okay.
Okay.
Oh, wow.
So let's go ahead and hand out our first award. I'm really glad that he's here tonight. The first one goes to Mr. Lemkool for his Tyson Foods selection just a few months ago, really. Every selection that is made, you can see that all of them there on the left are tagged by the person making the selection. Sometimes that person is the audience through the audience vote. The date of the round table is the purchase date, the average cost, and that is split and dividend adjusted. Current price, that'll be yesterday's price, I believe. But we look at the total return annualized for anything greater than 1 year, simple interest for anything less than a year. But you can see that Herb's pick of Tyson Foods was made at a cost of $41.69, and it's actually shot up to $64.10 in just a few short months, a gain of 53.8%, and a relative return, again, comparing to that Wilshire 5000 of 52%. And again, keep in mind the Wilshire 5000 is up about 6 or 7% in the last week. So from top to bottom, there's several things that I like here, but I'll let you guys run with it. I just like the distribution of ideas that I see here. Any thoughts?
Well, I like to see my name on these charts occasionally, and here I am with a silver and a bronze, so I'll take it, Mark. You know?
Sharing the bronze
You're
with
the
the
East
audience.
Germany.
Herb, I'm not going to invite you to any more roundtables, okay?
Well, we need him back. We got to get up over that red line, guy.
Okay, all right.
Yeah.
I like the versatility of all the stocks.
Yeah, I agree, Ann. I think the fact that they come from basically all areas of the spectrum is a very powerful thing. I mean, Kim Butcher is on here 3 times. She's not here to brag or receive the honor tonight, but look, take a look. She's up there 3 times for picks made in the last year or so. So that's
on PayPal.
Yeah, and what's interesting about this now, granted, this is a couple of places removed from a selection process, but something you say, Mark, and something I stress often, and I think we all do, is don't get overly concerned about diversification in your stock selections. Buy what's the best opportunity at any point in time, and after a period of time, diversification will take care of itself as the market cycles through. And now again, these are the top performers, so they've been somewhat weeded out, but notice the range. That's just about every month of the year, and notice the industry and sector diversification.
And Ken said he was happy to be on here up at the top of the chart. I'm just happy to be on this chart once after the year that I had. So again, just the results of 1 year, but a real big tip of our hat to Herb, and an awesome selection. Thank you very much, Herb.
I think what's interesting too, Mark, if you could stay on that for just one more second, is that you don't have to get really fancy to pick stocks that are really going to perform. I mean, I would suggest that 2/3 or 3/4 of the names on this chart are not stocks that are really foreign to a lot of folks in the audience. I mean, who doesn't know chicken and Google, and who can't identify with PayPal and ConocoPhillips and Scripps Network? So I really think you don't have to look for stocks that nobody knows about in order to make good money.
Yeah, and I should make a point that there is one on there that it was fairly unusual, and that came from Hugh, as usual. Ardelyx was actually up about 80% before it's actually relaxed back. And within the first 2 months of selection, Hugh, I think it was up 80%.
Exactly, yeah. It jumped up after the deal with, I can't remember which of the British pharma companies, but the deal, they took the drug back, they gave it back to Ardelyx, and Ardelyx has done quite well since then. But with any biotech company, it has its ups and downs, and it responds dramatically to even the whiff of any kind of news. And as somebody has said earlier, biotech's getting a bit of a hit right now. A bit of thumping.
Yep, a real thumping, and that's a good segue That's a good segue to Kim's stock for tonight. She'd like to nominate Amgen. Going to keep it really short and sweet. This is no stranger to many of us. Most of you know 100 times more about Amgen than I do. But on behalf of Kim, again, up straight and parallel. It's been fairly powerful, owned by many people within our community for literally decades. Company continues to be strong and innovative. I'm sure Hugh has a few things to do with them, but nothing wrong with that chart, up straight and parallel. And we'll just share that One of the reasons Kim likes it is, again, it's been thumped along with biotech, so you can see that that stock price on the Chronicle has actually been kind of stuck in the mud since August 2014. The company's fundamentals have continued to improve all throughout that time. You can see that it's basically flatlining in excellent quality. And the thing that we do like to point out during these sessions, it's trading at a multi-year high return forecast with the graphic, as the graphic shows, with the projected annual return there. So it's definitely on Kim's screen for potential core holding, and again, taking advantage of the carnage that's gone on in the biotech sector or biotech industry. So she's going to add Amgen to the pile tonight. So with that, let's go ahead.
There's just one interesting thing about Amgen that I always like to remind people, and that is that it's very difficult to have a blockbuster drug, a drug that sells over $1 billion a year. Amgen had 10 blockbusters. First 10 drugs that it launched all became blockbusters. So it's like the Pixar, if you will, of biotech companies. It's done spectacularly well. It has the golden touch.
What is your outlook for them going forward? Do you see continued innovation and good management?
Yeah, absolutely. Yep, it's a very successful company. It responds to the market very aggressively. Downsizings and hirings is appropriate. They have very strong R&D effort. So yeah, very bullish on Amgen.
Good stuff. Ken, any questions from the audience or any other thing that we need to take care of now before we move on?
No, we're staying current at the moment, Mark.
Okay, let's go ahead and press on. We have our second award, and this one happens to be for the best stock selection all time. So in other words, not limited to just the last calendar year. So going back all time, Mr. McManus takes away yet another. He needs a bigger trophy case yet again.
I'm getting one.
Do want to notice that I did get my name on this list last year, but IntelliQuint got passed up by Amazon. Now, Amazon had a tough day today, so I think I'm actually back in first place on this list.
Just stay with it.
That's Hugh, don't worry. That's called Robertson record keeping. It worked out that way a lot, so don't worry about it.
I could have switched the slide to get back into first, but I just want to. That just goes to my integrity. But again, top to bottom, a lot of people's names on here. I like the fact that the audience is on here a whole bunch of times. I will draw everybody's attention to that 3-pack in the middle with universal display. For those of you that are new to these type of to this scoring system, the ones that are highlighted with the prices bolded have actually been sold or removed from the portfolio. So you can actually see that some of those positions have been closed out. The other ones are still active, like Mr. McManus's Amazon and the OLED company. And Ken hit it out of the park with Google here over the last couple of years too.
And the last one, Southwest Airlines, in fairness, Mark, had we kept that, that would be, that hit close to $50 a share.
I know.
Which would be a 7Xer. You know, that would put you way at the top of the list. But if only.
If only.
Lesson learned.
We were happy at the time, though, and we certainly didn't see the expansion of profitability coming that has taken place. Any other comments? I started to make the comment about universal display. I've noticed it a couple of times when a multiple selection is done seconded by the audience. They've actually done pretty well. Southwest was obviously a joint recommendation by Hugh and myself, but universal display with Ken, myself, and the audience, that one's cranking along pretty good, and it's still active.
Mark, have you noticed on the television commercials where they're now selling these curved screen TVs that we first brought to the attention of our audience with this OLED presentation, and they're calling them OLED TVs?
I have seen those, yep.
Wow.
Yep.
And I do want to make one more point about this particular slide because it's actually kind of an interesting story. Hugh first presented Amazon at the Better Investing National Convention in a live session that we also broadcast to the world. That's the fifth one down there in May 2014. And I just want to say it was universally rejected by the room. There were probably 75 to 100 people in the room, and his selection was universally rejected. And a lot of it has to do with the difficulty of establishing an earning profile for the company. Again, they focus on cash flow right now. But
and Mark, in all fairness to that audience, Hugh gave us a picture where there was no blue line. So there, in all fairness to the audience,
you know to do that. Yeah,
So
I understand why they rejected it, but I also think that it's kind of a nudge to always keep an open mind. One of the things that we have pointed out with Amazon specifically is you can do a price to cash flow analysis that requires a different type of thinking. It's not for everyone, but using a price to cash flow very much like Value Line does, sometimes you can run into a hidden gem. And I think his selection of Amazon was quite outstanding, and it's performing quite well.
yeah,
Well,
if you're watching,
I think
go on,
truly
Hugh,
people will not. I don't think people will truly understand Amazon until about 15 years into the future, when they look back and they see a company that has totally dominated a market.
Yep.
You didn't realize they were really doing it at the time, but they have an infrastructure in place with warehousing, etc., logistics, the cloud, etc. They have everything in place, and it will be obvious in hindsight. That's my prediction.
It's interesting, Mark, that you had an entry point. We all had an entry point into Amazon at around 475 less than 2 weeks ago, maybe 3 weeks ago.
Yep.
That stock was as low as the 470s just very, very short time ago.
Yeah, and I believe it was down 9 or 10% today, so that shows you how bumpy the ride can be too.
Yeah.
So anyhow, some pretty good stuff from top to bottom. There's obviously some technology on there, but pretty broad diversification. And again, the ones that are not highlighted are still active and floating around on this chart. All right, let's go ahead and turn the session over to Ken and Cerner, his selection for February 2016.
Well, Cerner is in healthcare information. It's an industry that I've studied off and on for the last 10 years or so. I was quite high on a company called Quality Systems, QSII, about 8 or 9 years ago, and rode that for some considerable profits over a 3 or 4 year time span. Cerner has shaken out to be the big player in this healthcare information industry. They now have about 52% of the business in this industry. They're a national player and an international player, and they see one of the biggest growth drivers going forward, this shift in Medicare, which is going to start to pay doctors for how much progress they make on whatever the problem is with their patient. So they're going to have payments based on efficacy of their treatment, not just on dollar amount of the treatment for the patient. And Cerner is going to be a big player. They're developing tools to help evaluate the efficacy and also to tie it to the Medicare reimbursements. Obviously, that's going to be open to a lot of interpretation and a lot of long-term arguing about what it means to really help somebody do something. You'll notice that Cerner is near its 52-week low right now. That little red tick on the bar is kind of showing you that. Mark's pointing it out with his arrow right now. Mark, if you could click again. Cerner dates back to the late 70s, so it's been in business for quite a while. It is the largest worldwide standalone healthcare IT company, and their website is full of all kinds of presentations and webinars and slideshows and movies. If you want to learn more about the company, this is an extremely robust website with a lot of great information. And what strikes me is that they stress that they're a healthcare company, but they're also an IT company. 22,000 associates, 18,000 facilities, and a research and development budget of over $650 million. Click, please. Here's Cerner's locations throughout the U.S. You can see that they go from the East Coast to the West Coast. And then you can also see that they're beginning to put new facilities in the green shaded countries on that world map. All told, they have 120 new facilities through the third quarter 2015. We just finished the fourth quarter 2015, and it was a little bit disappointing for the company. I'll come back to that in a moment. Click, please, Mark. I like the research and development investment being done by the company. That tells me that they're serious about maintaining their lead as far as the big player in the industry. And Cerner is able to put enough money and leave their engineers alone so that the engineers have time to really develop software and hardware that are going to benefit the people that they're working with. They put a lot of money into research, and they get a lot of patents and have a lot of proprietary things that they use. Their customers sign long-term contracts when they enter into the Cerner system. And these contracts, some of them, many of them go into the 2020s, and a fairly large minority of these contracts move into the 2030s. So Cerner has a really nice, call it an insurance or a prepaid revenue stream going out 15, 20 years. The customers that they get are quite sticky because, as you can imagine, the systems themselves are extremely complicated. They're difficult for hospitals or doctors' offices to learn, and these facilities are extremely reluctant to change providers once they begin with this particular software suite. Click again, Mark. You can see that the categories that Cerner plays in, represented by the different colors on the bar graph, and you can see that all of their categories seem to be moving up as far as numbers of clients are concerned. They are anticipating around 14% growth from 2010 to 2020, and in this most recent 5 years, the growth, excluding acquisition, this would be organic growth, they're predicting to be somewhere around 10%. Click again, please. If you're interested in reconciling the Morningstar figures with some of the value line figures, Cerner does a nice job in telling you how it reconciles non-GAAP results and GAAP results. I found this in a presentation that they made at the Wells Fargo Health Conference. And if this kind of deep dive into the financials is interesting to you, the information is readily available. Click again, Mark. By now, you might have gathered that the first place I look when I'm researching something is their website, and then I move to this particular graphic right here. It's on the Manifest Investing page. You saw that graphic for Amgen and the same thing. I would have loved to have bought Cerner back in, I don't know, what is that, about June of 2013 when the par was huge. But I'm looking, I think, except for that one big hump right there, I think I'm looking at a time when the par for this company is at a historic high. I also refuse to look at a company where the quality line either isn't consistently good at somewhere around 85, 86, 84, something like that, or where the trend is decidedly up. And I think you can see from the 2012 quarter that starts this chart all the way up to the 2015 quarter that ends the chart, you can see that the quality has generally been moving in an upward direction. It's fairly decent today. It's more than fairly decent. It's in the top quintile. And I like what I see when I look at this particular chart. Click again, Mark. I go to value line real quickly at a price of $60, and Cerner is actually trading under that price today. Value line predicted the low return to be about 11%. So I would peg the low return from value line's opinion. As that price goes down, the return would go up. So I would peg the return at maybe 13, 14% from value line's point of view. Click again, Mark. I also like to look at these metrics on the Morningstar page for the companies I'm interested in. And here I'm looking at a comparison between the stock that I'm interested in, Cerner, and the industry averages as defined by Morningstar for that stock. A green bar means you have a favorable comparison, and a red bar means you have a comparison that's less than what's going on. For example, there's a red bar on revenue growth, industry average at 25%, but the largest company in the industry is still growing at 18%, and I find that to be a more than acceptable rate of growth. Net income growth, same kind of thing. This very large company, I would expect maybe to have income growth at 7, 8, 9%. Here we're looking at 11%, and granted the industry has a much higher income growth. There are some really good comparisons on this chart as well. Click again, Mark. Here's the Eagle right from the manifest site, and I am using the default values. I notice that the analysts are predicting sales growth of around 13%, and they're predicting an average PE value of around 30, and they're looking at a net profit margin at around 16.5, 17%. I think that those numbers are not that far off, although I'm a little bit more conservative when I do my stock selection guide. Click again, Mark, please. And I'm estimating EPS growth a little bit more robust than the analyst. I'm at 15% rather than, I'm sorry, the sales are 13% on the Eagle, and my sales growth is 13%. I did a preferred procedure. I'm coming up with EPS growth of about 15. If you go back one slide, you'll notice that's a little bit less than the EPS growth that the Eagle projects at about 20%. So I feel that if I can do a great SSG, with a lower growth for earnings and still get a nice solid buy, then I'm feeling very comfortable. I'm validated by the manifest site, and I'm feeling very good about the company. 2 clicks if you would, Mark. I've used an average PE also of about 30. I'm getting a buy. I'm getting a good solid buy for this stock. Click again. And I'm getting a return somewhere, and I like to read the return as a range, somewhere between 12 and 15.5. I would certainly take a return like this for this very large company. Click again. Nope. And that's the last slide. So I'm going to present Cerner. I think it has some interesting possibilities. And I like healthcare in this market right now. I like healthcare. I like consumer staples. And I'm beginning to like industrials and financials a little bit in this market as well. Right now I'm staying a little bit away from tech. I'm staying a little bit away from consumer discretionary, but I'm finding plenty of great ideas in the healthcare sector, the financial sector, the industrial sector, the consumer staples sector. So I'm not out of ideas by any means. Mark?
Well, thanks, Ken. We'll go ahead and add that gorilla to the mix. Certainly a big one in that area. Let's go ahead and hand out our People's Choice Award for Best Picture. And what I did is I went back and, first of all, going back over the years, there have been some awesome presentations made here. Ken Kavula's pulled pork presentation, no matter how it turned out in China, was an awesome presentation. That 2011 presentation of more Spock and less Kirk, rest in peace, Mr. Spock, was outstanding. Cy Lynch's Tava really captured some pretty good stuff. I'm very proud of the work done by Eddie Elfenbein at Crossing Wall Street. Matt Spielman's 2014 entry about the guy who quit the company, walked across the parking lot and started up a competitor at Air Lease was priceless. And then I just wanted to take a moment to acknowledge one of the audience's favorite things that we do. And Hugh does it a lot, and we model some of that behavior. under this topic of here are a few of our favorite things or screens, and the 52-week low proximity test that we do, that Hugh features often here in these events, are just an example. So we'll give Hugh another statue for his trophy case, and thank him for that contribution.
Thank you.
And in that spirit, what I thought I would do is, again, many of you are familiar with our stock picking contest that runs from Groundhog Day to Groundhog Day. And we do like to share the consensus favorites that are picked by the participants in that. And one of the reasons I love doing this one is, first of all, for the first time that I have in recent memory, now it's only 20 days old, but 90% of the participants are beating the market since Groundhog Day this year. And this is a group of the stocks represented consensus favorites top to bottom. And I gotta say, this is really quite an eclectic and powerful list also. Some very decent ideas from top to bottom. What you see here would be $50,000 invested on February 2nd. And again, you can see most of those are above the starting point, with just a couple of exceptions. In fact, Cognizant is actually the weakest of the 20 that are pictured here. But there's certainly nothing weak about Cognizant over the long term. Again, top to bottom, there's some pretty interesting ideas. And the Groundhog community is probably pretty worth listening to. So you might want to take a look at this as a place of shopping ideas, as one idea of a screen put to work. Another one that we love, again, we implemented this based on Hugh's appetite for shopping near 52-week lows. You can actually use the screener at Manifest to target and highlight companies that are operating near their 52-week low, in addition to being excellent companies with good long-term expectations. And again, if we'd have run this list a year ago, those of you that were here for the program last February, he closed with a Seinfeld slide basically saying, there's nothing out there for me to invest in. I think the picture is dramatically different. We might actually get a selection from Hugh tonight. But again, top to bottom, some community favorites on there along with a couple new companies, but just offered for the audience's pleasure and shopping efforts. And Hugh has promised me that he's probably going to do some shopping. Top to bottom, some companies that we've covered quite a bit.
Mark, have you posted the 2016 Groundhog yet?
Going to post it within the next couple of days.
Okay.
Mm-hmm.
Just a question.
Mm-hmm. All right, let's go ahead and press on. I'm going to go ahead and highlight the company Stifel Financial, ticker symbol SF. Every Friday, we put out a list of 5 companies that we find compelling at Manifest Investing. Here were the 5 from the most recent Friday. Astronics, Stifel, and Telequint actually working its way back up onto the list. Aaron's we featured a few months ago, and Argan, a new company, that's a tech services company. And again, just kind of looking down over the entire list, I'm just looking for companies that have good long-term expectations, decent quality, if not excellent quality. I'd love to see Value Line agree about the long-term prospects for the company. You can see that Astronics and Stifel have pretty good Value Line low total return forecasts. I'd love to see Morningstar consider the company to be on sale at 52%. That's like 48% off of the fair value for the company. So Morningstar thinks Stifel's on sale. Same thing for Standard & Poor's. We compare the current price to what they consider to be the fair value. Anything under 100 is potentially on sale. So you can see that S&P concurs on SF, and they also concur on Aaron's. And then just a quick look at, what is the outlook for the next year? I don't really put too much stock in this, other than I do believe that this might be the only sentiment or momentum indicator that makes any sense to me. If the analyst consensus or the companies like Goldman Sachs or Merrill Lynch have elevated expectations for the next 1 year period for any company, that could be a source of potential, almost sometimes as reliable as gravity you could think of. But from this list, I like Stifel Financial. It's an M&A story. It's a company that has basically grown through a continuous series of acquisitions. Kind of reminds me of Danaher, but only on the financial services side. They are really getting into the investment advisory side of things, wealth management, and that type of thing. And you can see going all the way back to Ryan Beck and companies like Thomas was old partners. Knight Capital's group there that you see, and then a couple of fairly major acquisitions here in the last couple of years with Stern Agee and Barclays Wealth on here. So again, this type of company, you do want to be careful as you do your study and focus in on the right-hand side of the business model or visual analysis, and certainly never apply a 23% compounded annual growth rate to virtually any financial company, because it just simply can't be there by definition unless it's not organic growth. And again, growth by acquisition. Here's a quick look at the company. Again, fairly up, straight, and parallel. It's been fairly strong over the years. Again, they've been acquiring these companies as the years go by. It's been knocked down a little bit with much of the financial sector, just as Ken was suggesting, that there seem to be some opportunities there. As others have pointed out, it's at a fairly high quality rating and trading near multi-year highs when it comes to the return forecast. I would look at the company and notice that they are trading below book value, which is a pretty good situation for a financial, but I give them a 7% growth forecast for the pieces of the puzzle that are put together in their present form, a decent return on equity, and a PE that's defensible in the 16 range. Basically come up with a company that's trading somewhere in the upper teens for a return forecast and a very nice quality rating. They did just refinance some of their debt and drove down their effective interest rate, so I expect to see the financial strength rating actually tick up. But again, up, straight, and parallel for the most part. The one other thing that I really like in this slide is that, if you go back and you take a look at the performance during the Great Recession of many of the financial sector companies, many of them were in a bloodbath and almost got taken out. Many companies in this sector actually disappeared from the planet back in that time frame. And notice that these guys, the price suffered back in that time frame, but the fundamentals were pretty good throughout that entire test of the metal at Stifel Financial. And I really like to see that strength, because believe it or not, one day we will have another recession, and it could be a bad one. So with that, we'll add Stifel Financial to the list of companies at Manifest Investing. So let's go ahead and talk about, we mentioned it near the start of the program, we like to pick stocks that go up after we select them and keep track. So let's go ahead and give the highest accuracy for 2015 and the all-time awards. We have a breakthrough by a damsel here with Kim Butcher. She went 4 for 4 in the last calendar year for 2015. So again, tipping our hat in the direction of Evansville, Indiana. And I know Kim was not able to join us here tonight, but again, congratulations to Kim, and certainly appreciate the powerful performance that she's been delivering. And lo and behold, here's Mr. Lynch. I love this one, guys. I can't tell you how many times Cy over the years, every time I've said something to him about virtually anything, he'll just smile, tip his glasses down, and say, it takes time. So again, he's arrived at the top of the all-time accuracy list. So Cy, any thoughts or acceptance speech for the audience?
It takes time, and I have not seen the entire list, but just noticing on the top holdings and thinking back to some of the selections that were not roundly received or applauded back over the years, that I suspect are looking pretty good right now. Teva Financial being Teva Pharmaceuticals being one, because it has run up and done quite well. But that is one that needed patience, and I remember saying that a couple of times. And of course, Hugh is probably the champion of patience and well.
And a distorted outlook. Warped.
So there's another one.
Yeah, those buggy whip companies.
Although, Hugh, before I pat you too hard on the back, I do like blue lines on my companies.
Ah.
What a radical thought. Well, congratulations to both Kim and Cy for their accuracy. And with that, we'll go ahead and take a look at Cy. He's joining me in the financial sector tonight. we're going to split the vote and the other candidates are going to win. We need to work things out ahead of time. But go ahead.
Yeah, I'm afraid we may do that, Mark. But one thing, I don't have a slide on it or on where it comes from, where this pick came from, and actually I did not check the actual chart until after I had decided on First Financial, although I was pretty sure what I would see. But there are only 3 sectors right now, according to the Manifest Sector Radar, ETF Sector Radar, that are projected to beat the market. Discretionary, consumer discretionary is roughly expected to match the market over the next year, return about par. The only 3 expected to beat the market are healthcare, financial stocks, and then technology. That's in reverse order. So right now, financial stocks are somewhat in disfavor. And interestingly enough, so are technology, although technology has also been one of the best performers up until this last little correction that we've seen. So that's not a bad place to look at. And here's First Financial. As you can see, good, solid, up straight parallel. Notice also, as Mark pointed out for Stifel, look at that 2008-2009 time frame. You see some flattening on the chart, but that actually is up in both of those years. Despite the Great Recession, they have in fact increased earnings for 28 straight years. Next slide, Mark. Let's go ahead and look at how I did find First Financial. I did a stock screen. You can see the criteria, a par of about 13, quality of 80 for excellent, and right now, again, given the market at relatively high levels, I like to tighten financial strength a little bit at 90. And here you can see First Financial is pretty near the top of the list. It's, I believe, well, Berkshire is on the list, but other than Berkshire, it's the only financial stock on the list. And I was kind of interested in financial stocks, although notice Cognizant, and that was a tempting pick tonight, but I thought I'd bring something new. Next slide.
Nice restraint, Mr. Lynch.
Here is the chart that comes up whenever you start a company research on Manifest. You click on research, click on companies, and this is a Sweet 16 type of screen that combines quality and par and companies that are in the green par range. That's being between 5 and 10% above my par. Again, First Financial shows quite well on this list as well. Next slide. Another thing that I like to do when I'm investigating a company is go ahead and click on the industry link on the stock study page. Here we see banks, financials, financial sector banks in the Midwest, a little mini industry study. This particular chart is ranked by par. You can see there's only 3 companies listed here that have excellent quality ratings as well as in the higher par range, that being BOK Financial, First Financial, and U.S. Bank Corp. And I've circled the things on this particular chart that caught my eye. They've got one of the top margins, just slightly behind U.S. Bank Corp and Bank of the Ozarks on the page. One of the higher growth companies next to Texas Capital, and then an outstanding financial strength. Second, again, to U.S. Bank Corp. So all the way around, I thought that First Financial had good quality and sub-quality portfolio characteristics. Next slide. Here's just a little bit about First Financial. It's, if you haven't already guessed, it's a bank company. It's headquartered in Texas. It's 125 years old, started in Abilene. That's still its largest market today, although it has expanded both through organic growth and acquisition. in Texas. I'll show you a little bit more about it. Those of you familiar with the Georgia regional bank Synovus, First Financial seems to have somewhat of the same management approach that Synovus had. They call themselves a regional bank with local management. Notice that they have 11 separate regions. They have 70 banks locations in the company divided into 70 regions, and those regions are actually managed as separate profit centers and have separate senior management to do the market analysis and the loan analysis and the like over those regions, so they try and keep a more local management feel to the bank, yet have the consolidation for backroom operations and overhead to help try and keep those down. Next slide. Actually, they mentioned some of that in this particular slide. One bank, 11 regions. I'll show you the efficiency ratio and the results, how that compares to its peers in just a moment. And then here are the regions and their goal of having regions as opposed to one centralized management is. Next slide. Here's the geographic distribution throughout Texas. You see a fair bit in Dallas-Fort Worth, Abilene, and then spread out some in Houston, and then throughout some of the other outlying parts of the state of Texas. They also have, I believe it's 7 trust office locations. A fair bit of their business is trust management as well. Next slide. Here are their 3 largest markets. It's about half of their assets. The company has almost $7 million or $7 billion in assets, 7,000 million to match this slide. You can see again the Abilene region is the largest. Notice that they have they're #1 in the market in each of these markets. And in the first 2, that being the Abilene region and the Hereford region, have almost half of the deposits in those markets. So they try to be very strong where they are. Next slide. One reason that the stock price has been beaten up so much with First Financial is, of course, the overall dissatisfaction or disfavor of the financial market or sector as a whole, but also the fact it's a Texas bank. Much of their loan portfolio, here is their loan portfolio, much of it is in real estate. I'll show you in the next slide the breakdown of that real estate portfolio. But you see they have a fairly diversified commercial, consumer, little bit of agriculture in their portfolio, and they're saying that their oil and gas exposure, which would be direct exposure, primarily in that commercial area, is only 2.89%. So they don't have a whole lot of direct oil and gas exposure. Of course, to the extent the Texas economy depends on oil and gas, certainly all of those sectors, loan areas would potentially be influenced by oil and gas. But as Hugh will probably be telling us later on tonight, oil isn't going anywhere. It will come back. Next slide. And on that note, I'll also mention one of the things that the company is very proud of is that they survived and in fact thrived. They were buying banks and increasing branches during the 1980 oil crash in Texas. So again, they have withstood the Great Depression, the 1980 real estate and oil bust in Texas, as well as the Great Recession that we've seen in the late 2000s. Here is a breakdown of their real estate portfolio. Again, you see that about half of it is single family or up to 4 family residences, and then pretty dispersed otherwise, larger residential development, commercial as well. Next slide. One thing that I like to look at in banks is their interest margin. This is their profitability on their loans. Essentially, the difference between what they're collecting on loan payments minus what they are paying out on their interest-bearing deposit accounts. And you can see what you like is a steady to uptrend. You see that over the last 4 years, it's been a very steady, almost up trend. For First Financial, that being the red line on top, and notice significantly better than its peers, running about 30% above its peer group bank competitors. Next slide. The other profitability measure for banks is called the efficiency ratio. This, the net interest margin measures their loan profitability. This measures how profitable they are on everything except their loans. What you do is you take the non-interest expenses and you divide that by their non-interest income. It's the kind of the flip side. It's not a profit margin. It's actually the expenses divided by the income. And you can, if you flipped it over, it would be a profit margin. Again, you see a relatively steady trend for First Financial at around 50%, and again, significantly better than the peer group, because again, remember, this is not a profitability margin, so lower is actually better in this case. The worst year on here, for example, is 2013. This is a cost ratio, not a profitability ratio. Next slide. And then a couple of measures that are very important in banks: percent return on average assets. Banks have a lot of assets, relatively low percentage returns on those assets, so you want to follow that. You can see percent returns just between 1% and 2% at First Financial, but again, much closer to 2%, a good return on assets, and again, well above its peers. Next slide. And then finally, another profitability measure important to banks being return on equity, and in fact, that is the profitability measure used at Manifest Investing to calculate earnings per share, or well, net profit, and then eventually earnings per share is the return on equity. So again, a very important measure, and again, you see that quite solid, relatively steady for First Financial, and again, well above its peers. Next slide. Now just take a quick look at my judgments based on that. This is just the first slide again. You can see the sales growth over the last 10 years has run about 7%, and while it's actually a little hard to see on this slide, it actually has increased every year since 2006. So it is an accelerating, and you can see it pretty clearly there. Mark's just marked the last 4 years. But it is actually accelerating. So I chose to use 9% sales growth, and this is actual top-line revenues for the bank. This is not the assets, or excuse me, the equity that is used on Manifest Investing to calculate it. Interestingly enough, though, we came out with relatively similar bottom line on earnings per share. Next slide. Here, the top of the slide, the typewritten looking things, that's actually my expected income statement off of Investors Toolkit. You notice that I'm expecting a little bit of a decline in pre-tax profit as interest rates go up and as they are challenged somewhat with potential economic downturn. They increased their loan loss provision in the last year, although I think that may well, I haven't dug deep into the footnotes to see it. It was nothing alarming. It was just interesting that they were up, but they just made a large real estate portfolio acquisition, and I suspect it has to do with that. They nearly doubled their residential real estate portfolio, and I suspect that's what that had to do with. But again, that will drive the profitability down a little bit. And actually, that 48%, when I say decline, that's off the average. 2010, 2011 was actually very high, well over 50. The 48 is actually pretty close to the current profit margin. And then you see the PE ratio. Again, the company's very steady. I just decided to choose the median over the last 5 years, which gave me an average PE of 18.3 roughly over the next 5 years, and a potential high price of 48.9. Next slide. And then it's a little bit small at the top, but that's the section 5 of my stock selection guide, giving a potential average return of 12.6, which is, again, applying that 18.3 average PE times the earnings per share. And then what's below it is the expected income statement from manifest investing. And you'll notice that it's actually a little more optimistic than my projections, although I'm very comfortable with the manifest projections as well as with my own. And using either figure, this looks like certainly a solid company. And I will stop my presentation today by just saying what really attracted me to First Financial after I had looked through some of the screens that I had mentioned above and had a little bit of a gut, is I saw that the quantitative, this, by the way, this company is not followed by either Morningstar or by Value Line in its standard edition. It is in the small and mid-cap Value Line edition. But I noticed that S&P Quant, the S&P does not have an analyst assigned to it, but they do a quantitative evaluation, and they are rating First Financial a sell. And right now the market hates banks generally, I think. First Financial for some reason in particular, yet the same people, Charles Schwab also has it as a sell. They saying, analysts saying that it's a sell, say from growth and profitability standpoint, it's positive. So that to me sounds like a screaming buy for those of us who have long-term prospects. Buy something that Wall Street hates in the near term, and then be willing to be patient. And remember, as we all started at the beginning, it takes time.
Thanks, Cy. Excellent. And it actually dovetails with some of the remarks that Ann Manning made. She lives in Houston, about the Texas economy, and that Texas is not all oil and gas anymore. So,
Mark, we have a hand raised from Pat. Pat, go ahead. You're unmuted. I'm going to guess this is an inadvertent hand from Pat. I'm going to take the hand down and put her back on mute. Cy, you had a lot of questions about the oil exposure, but once you explained that, the questions kind of dried up. So I'll come back to them if we need to in a little bit. Mark, why don't you keep moving then, okay?
Yeah, and I just want to say I think it's a great example of, I think investors around the world and traders make the mistake of assuming that there's all that oil and gas exposure, and it's not always the case. All right, let's go ahead, and we're kind of coming down to the end of the night. The best picture and best editor and all that kind of stuff for on the movie side of things, but this is for best performance in a leading role. We're talking about performance here, and we're talking about performance just over the last calendar year. Again, I like to see my name on slides like this, even if it is just once. But you can see Hugh had a heck of a run for 3 years, and then Ken and Fuego Cavula for his run in 2013. But this year, and we celebrate Kim's 4 for 4 in her 4 decisions that were made during the course of the last calendar year, and she actually has the highest return performance also over the last year. That's her picture from her participation in the Berkshire Hathaway weekend out in Omaha out in May. So again, congratulations, Kim, and good work. And while we're here, let's go ahead and do the best all-time performance. It's a category dominated by Mr. McManus with his colorful picks. He is once again the leader in the all-time standings and the best performance. And I believe we say that he's gone to the dogs again. For those of you that don't know, he was a lover of Irish Wolfhounds. And I think that's Lear and Louie in that picture, Hugh.
That is Lear and Louie, yeah.
So
it looks like they've recently had a bath.
Some good stuff, but congratulations for continuing to lead. I will make the point that the spread from the number one person, Hugh, down to the people bringing up the back of the bandwagon is actually narrowed quite a bit, and it's only a few percentage points now. 4 or 5 of the participants, either knights, damsels, or whoever, are above zero. So they're all packing in pretty close to Mr. McManus. So the game is, how they say, the game is afoot. So good stuff going forward. And we'll let Hugh close down tonight's stock nominations with, again, his repeat selection of ConocoPhillips. Now, Hugh, I didn't have any slides from you. I just put in the value line. I figure you could talk to some of the themes and prevailing influences that you're looking at these days with companies like this.
Yeah, I did get the slides in very, very late, so I'll talk very briefly. There's not really a lot to say. And as Cy pointed out, oil isn't going anywhere except into storage, it seems, for the last couple of months. But it isn't going anywhere. It's probably the greatest invention of the industrial age, pulling a bit of liquid out of the ground and converting it into something that can generate heat. But there's a lot of nonsense right now, I think, personally, on the news about oil. The fact of the matter is that the U.S. has been producing more and more oil over time. The technology has really matured, and even when people think that they've reached a low in terms of what they can extract oil out of the ground, people improve the technology even more and extract more efficiently. But the fact of the matter is that in the North Dakotas of the world, R&D or investment in new fields has all but closed up. Oil has been plummeting, and it has been plummeting for a very simple reason, that demand, despite what people always say, is relatively flat. People don't really cut back dramatically when oil prices go up. Have to go up maybe over $4 a gallon, and you might see a little bit more carpooling, but you would see a decline in activity of a few percentage points. It doesn't respond in the same way as gasoline prices respond to a drop in the price of crude oil. And similarly, when oil price goes down to 30 or 25 bucks a barrel, and gasoline prices in some parts of the country, they claim, has dropped below $1 a gallon, certainly not in California, people don't get in their car and say, you know, I should drive more because oil is so cheap. Yes, you mightn't consolidate trips to the store anymore, and there might be more sensible behaviors when oil prices is high, but generally, the demand is inelastic. And the supply and the demand, as I'll show, I'm sure, in succeeding months, is always pretty much in check. The exact amount of oil that people require for various reasons that you produce oil is usually lockstep with production. It may be off by a couple of percent, but thanks mainly, I think, to production in the US, it has been off by quite a lot recently. And last year, production was far higher than demand. It has narrowed slightly recently, and it continues to narrow. But when you look at the cash cost of extracting oil from the ground, I do not know where people can seriously come up with a conclusion that oil is going to $10 a barrel, because virtually no one outside of the Gulf can produce it for that price. It will drop. I mean, it's at 30, and that seems a natural hold. And I remember saying that at the National Convention 2 years ago. That's a natural break because a lot of people produce oil on a cash basis at 30 bucks a barrel. There's some who are cheaper, but I don't see oil going there very long. And a company like ConocoPhillips, which is a relatively strong balance sheet, yes, it has borrowed money to pay dividends, but it is in good shape, will be able to sit this out. Many of them will, the Totals of the world, the BPs, the other discovery companies that are further upstream and therefore more vulnerable to what's happening with oil right now, are seeing their prices get decimated. And this is when I get extremely happy and joyous. And today, ConocoPhillips closed at $32.92 a share, just 1 penny above its daily low, but not much higher than $31.05 a share, which is its 52-week low, and it's low, I think, for the last 5 years. So I think we're witnessing something exceptional in companies like ConocoPhillips as they visit lows for extremely good reasons, but this will be temporary. I don't see how oil can stay close to $30 a barrel, because what's going to happen is production is going to slow down, the oil reserves will get drained, and then the price will go slowly climb back up to 50 to $60 a barrel, where that seems to be a natural price break for oil because it's slightly higher than extracting oil from the Canadian tar shales. So that's what I think is going to happen. I don't know timing for that, but I do know that while companies such as ConocoPhillips are depressed, I will happily continue to buy them and stock up in a portfolio with the expectation that the price will rebound and rebound dramatically when the price of oil rebounds. And by the way, when you look at conservation techniques, yes, you do see that the average consumption of oil in the U.S. is dropping slightly, thanks to conservation activities, etc. But it's not going to make a huge dent into the market. And the fact is that there's 96 million barrels of oil consumed every day. That's 16 million barrels more than about 16 years ago. It is climbing, and it's climbing steadily year on year as emerging economies start to do what economies do when they emerge and have homegrown industries. They need more energy, and most of that energy comes from oil. Not most, about 40%, a big chunk of it. And so they will continue to consume oil. So it will continue to rise. It's not going to rise as rapidly as it did thanks to the slowdown in China, fewer cars getting bought, etc., etc. But oil consumption, I believe, will continue to grow. Yes, at a slightly muted rate, but it should be 97 million in about a year and a half, and then it'll be 98. We'll eventually hit 100 million barrels a day, and keep growing. The only big fear I have is Venezuela, which has the largest proven oil reserve on the planet, but is not even in the top 10 of producers. So when that country gets its act together and starts producing oil again, that'll have a negative impact on price. That's a little bit away. They're currently paying, I think, $40 a share, $40 in cash to extract oil from the ground. So the break-even point for them is a little bit higher than even close to the North Sea, not near what you can produce oil for in the U.S. So I'm bullish in a company like ConocoPhillips, but it is a long-term play. But I do believe that oil's well that ends well.
Hugh, I have a question for you.
Okay.
In previous roundtables, you've chosen BP as an addition to the portfolio. Is there a reason you've moved to ConocoPhillips, or are you basically recommending all of the large integrated oil plays?
I think it's all of the large integrated oil plays. I like ConocoPhillips a little bit better because it has more exposure upstream. I like BP because it had a super fat dividend yield, but it's an unqualified dividend, so yeah, you do pay a little bit of extra tax on that thing. But ConocoPhillips will also not be exposed as much to currency fluctuations, although their prime asset oil is denominated in dollars, so BP will be exposed to currency fluctuations a little bit, but not as dramatically, I guess. And they're all international companies anyway.
So a follow-up would be that ExxonMobil would be on this list as well then?
I love ExxonMobil, but I think it has upstream activities, which ConocoPhillips doesn't not. That's now Phillips 66. So, yeah, ExxonMobil doesn't have as big of exposure to the downturn in the oil share price decimation. Hasn't been near its 52-week low for a while.
Okay, thank you.
All right. Well, with that, I think we can go ahead and go to our poll, Ken, and close down tonight's session.
Let me just get there, Mark, if I can.
I also like to see that.
And there we go.
Value Line had a low total return forecast of 18% for Conoco, and that was at the $35 price point.
So we'd like you to shake your mouse and just make a choice as to what you think might be the best play for the portfolio. You have 5 choices this evening. That's about half of you voting. Let's leave the polls open until we get maybe 80 or 85% voting. We're up to 75%. 80%. Let's leave it open about 5 more seconds. 85. 86.
Come on, Stifel Financial. They're good closers.
Okay, I'm going to count to 10 in my head and close. We're at 88% voting. All you have to do is take your mouse and click on what you think you'd like to add. And I'm going to close the poll and share the results. Folks, I don't know why you stick with me. I've had a lousy run the last 12 or 13 months here, but I appreciate the vote. Thank you.
Wow. I guess I got closed.
Yeah, I can't believe I got a higher percent than you, Mark. What's wrong?
Wow,
I know. ConocoPhillips has earnings. I apologize.
oh, there you go.
I'm going to hide that poll, Mark, and you're ready to go to where you want to go to now?
All kinds of fluctuating earnings. Well, we're going to stick around and answer questions for 5, 10, 15 minutes or whatever. It is kind of one of our favorite celebrations of the year. And again,
Mark, if you can watch the question box for about 3 minutes, I'm going to have to be away from the machine, okay?
Okay. We're going to take a quick break. Again, we do like to point out some of the other things that we'll be participating in. Ken will be in Sacramento March 12th for an investor fair, and I believe that's an all-day session. The March roundtable, again, we've pretty much standardized on the last Tuesday of every month. That may move around a little bit depending on holidays, but we're going to try to stick to that for a while. All four of us will be at the National Convention in Chantilly, which is code for Washington, D.C. in May. And Christy Powell and I will be part of the team on Wall Street. That's an Alaskan cruise in September, and we're looking forward to that. There'll be some other dates that we add to this, but these are just some of the things coming up that wanted to take a look at. And again, congratulations to everybody involved tonight. I would take note that I got a few awards last year, but I was shut out again this year, so I know how some of those people feel at the Oscars. It's a tough crowd out there. I did take down. I will be sending Christmas cards to anybody who voted for Stifel Financial tonight, and I won't be using many stamps apparently, so that's a good thing, I guess. And I'm going to go ahead and shut down the recording, and we will stick around for a few questions if people have them. But again, congratulations to the award recipients tonight, and thanks to all of you for participating. Get out there and share your best ideas with us. We'd love to see them. Thank you.